Welcome to another episode of A Quest for Twice. Today is September the 1st. I'm going to do a brief update on Boston Beer and then provide a deep dive on Bright Horizons. So Boston Beer reported a disappointing second quarter results. Its volume growth for the full year now is forecasted to decline by 2 to 8%. That's a revision down from 4 to 10% growth given previously. And that itself was also a revision down from previous guidance. And its gross margin now is forecasted to between 43 and 45%. A revision down from 45% to 48%. That's due to cost inflation and lower production. Those are disappointing numbers. So using the latest guidance, EV over 2022 EBITDA will be around 21. So that's no longer considered cheap for a growth stock. The key question is can it resume growth? I have no confidence and also very little insight in the alcoholic beverage business. Boston Beer appears to be a bad investment decision for me. I don't plan to add more even if the price pulls back. Now, let's do a deep dive in Bright Horizons. It's a leading preschool childcare operator. Has over 1,000 childcare centers worldwide, including more than 600 centers in the United States. It has 6 times more market share compared to the second largest provider, KinderCare. And also, very unique part of Bright Horizons model is that 2/3 of its U.S. centers are affiliated with corporations. To the right, I provided a breakdown of its customer and markets. A third of its customers are in the healthcare and pharmaceutical industry, and 16% in the financial services industry. It also provides backup care for corporations. The high retention rate, about 95% annually. Thirdly, it provides educational advisory and other service to its corporate customers. In 2019, its full-service center-based childcare contributes about 82% of its revenue versus 74% in 2021. The decline is because of the pandemic and the closure as well as reduced occupancies in its childcare centers. On the other hand, its backup care actually did really well during the pandemic because of so many children were staying at home. Figure on the right shows the revenue and the gross margin of Bright Horizons from 2008 to 2021. So the revenue CAGR was about 8 to 10% before COVID, a significant dip in 2020 and 2021. With the latest guidance, the 2022 revenue will come in around $2 billion. That's still less than the 2019 revenue. The revenue growth was partially driven by tuition growth each year for about 2 to 4%. What's even more important is its gross margin expansion. So the gross margin was close to 20% before 2011. And in 2019 and 2018, gross margin was about 25%. Most of the cost of service was payroll cost. So what drove the gross margin expansion? That's explained by the figure at the bottom left. The red curve shows the gross margin from 2013 at 23% to over 25% in 2019. That's corresponding to the revenue contribution from the full service segment. The contribution was over 85% in 2013 and approaching 81% in 2019. So the conclusion is the gross margin expansion was driven by the higher margin backup care that contributed more and more in terms of revenue percentage. Next, let's take a look at the competitive position of Bright Horizons. On the right, there is a pro forma lease model gross profit provided by Bright Horizons. So it takes about $2.5 million to open a full-service child care center with a capacity about 150 kids. At the maturity, the annual revenue is about 2.5 million and takes over a year to break even in terms of cash flow. The revenue ramp up will reach maturity around year 4. So that's a significant entry barrier for small operators to put in significant capital and also to wait for over a year for cash flow neutral, let alone recover the investment. The high margin backup care is built on scale of full service centers. So for small operators, it'll be difficult for them to work with corporate clients to provide backup care. Therefore, there is a moat around the Bright Horizon. So to break it down, I don't think there is any network effect. However, there is a switching cost because kids and parents don't really want to change caregivers unless they have to. So there is a stickiness to its business model. For the corporations, it's difficult to use small operators because they may not satisfy the safety and other requirements from large corporates. And also, I think there is a intangible asset contributing to Bright Horizons moat. That's possibly in client relationship with over 1,000 customers and its brand and scale. So pre-COVID, its return on invested capital was about 10% per Morningstar.com. That's also an indication of its narrow moat. Can its growth resume? I believe that will be the case because of the growth drivers I'm going to discuss on this slide. For the short term, it's pretty simple because the full service segment is not operating at its potential and below its pre-pandemic occupancy rate. For that segment, the trailing 12-month revenue was 1.4 billion versus 1.68 billion in 2019. Its margin was 5.3% in the most recent quarter versus almost 10% in 2019. But if we look at the operation margin trend shown in the bottom left figure, we can see that that margin has been recovering with a dip in the Q4 last year because of the Omicron variant. So I believe its ops margin as well as the segment revenue will recover to 2019 level and beyond, because the narrow moat of its business will enable it to pass on its cost inflation to its customers. As a result, its revenue should be higher than 2019 because of the inflation. For the long term, the company provided a steady state long-term revenue bridge for growth. So 1 to 2% revenue growth will come from opening new centers, and the tuition increase will be 3 to 4%. Enrollment will be about 1 to 3%. And with the growth in the backup and other services, it will contribute to about 1 to 2%. So its organic growth will be about 8 to 10%, as the case before the pandemic. The company also sees itself closing some underperforming centers with a 1 to 2% of a reduction to its revenue growth, but that will be offset by acquisitions. So this bridge makes sense to me because of the four pillars of its growth drivers. The first one is a new client relationship because its client base is only 10% of the total addressable market. And I believe it will be able to open new locations that's not affiliated with the corporates. On the corporate side, it will be able to continue to cross-sell its services, especially the backup care service. And also, it's active with the acquisitions. A part of the business I like a lot is how much cash it generates. So this table shows the EBITDA in the last 5 years plus the first half of 2022. So we can see that the capex plus mergers and acquisitions in the past usually is significantly less than the EBITDA. And the interest and the tax payment, which are cash cost, should be subtracted from EBITDA, usually adds up to less than $90 million a year. As a result, Bright Horizons should have a lot of cash left after paying interest and tax. That can be more than enough to pay capex and doing acquisitions. So recently, the company announced a fairly large acquisition that's called Only About Children. That company has 75 centers in Australia. Bright Horizons paid $213 million in July of this year, and another $106 million payable at the end of next year. So its growth strategy is intact. Now let's take a look at the valuation and the risk. At the current price, about $69 per share, its enterprise value is about $5.5 billion and market cap about $4.0 billion. So its EV over 2019 EBITDA is about 14.6. That's reasonably cheap for a growth company that's growing 8 to 10% each year in revenue. So what are the threats? The first one is a recession may be on the horizon in the next 12 to 18 months. A recession may lead to fewer working parents. As a result, they may choose to take care of their children at home instead of sending them to Bright Horizons centers or receiving backup care from their employers. Another threat is that because of post-pandemic, there could be more parents working from home remotely. So they have less needs for full-service childcare centers at their workplace because since they are now going into work, they may not choose to send their children to the childcare centers located at their workplace. On the other hand, there are several opportunities to Bright Horizons business. First one is the tight labor market may lead to better employee benefits, including sponsored childcare. At least from my personal experience, that was a highly valued benefit when I was working at my previous employer. And also, Bright Horizons may gain market share because of so many childcare centers closed during the pandemic. One statistics to show that closure is the daycare employment now is about 10% below the 2019 level. That's because of so many closures and layoffs in the industry. Third opportunity is the company may pass wage inflation due to its pricing power, as I mentioned earlier, and that's tentatively supported by the record high gross margin in the most recent quarter. Lastly, I see Bright Horizons continue to grow its high margin backup care because of its strong client relationship and scale. And as I mentioned earlier, there is a narrow moat around it, make it difficult for other competitors to enter this high margin business. Balancing the longer term opportunities against the shorter term threats. I think the current valuation level is reasonably cheap. I plan to buy the company stock during pullbacks. Until next time, happy investing.